5 mortgage tips to help you get the best deal. While some people can find a home they like and negotiate a fair price, many can find it difficult to get past the mortgage stage. This can be for various reasons, but today's most significant challenges include home buyers being unaware of their options, increases in house prices, and employment issues. Fortunately, if you know what you're looking for, the process needn't be as complicated as it first appears. We'll share our top 5 home loan tips that will make your life easier and hopefully result in the best deal for your circumstances. If you're like most people, you'll need a mortgage to make the greatest financial investment you'll ever make, buying a home, a reality. There are certain things you can do to improve your appeal to lenders, even if there are no assurances that you'll be approved for the mortgage you desire. Discover the finest advice for raising your chances of obtaining a mortgage by reading on. Why is it so difficult for so many people to buy new homes? These days, it might be difficult to purchase a new house for a variety of reasons, but one of the biggest is job loss. Additionally, a lot of recent graduates struggle to locate well-paying jobs that would allow them to afford their monthly mortgage payments and early down payments. House prices have soared in addition to rising interest rates and labor market difficulties. This is particularly true in the Nordic nations, as seen in the figure from Compare the Market home loans above. Denmark in particular has witnessed a rise in household net worth of 18% from 2019 to 2020. Instead of a pay raise, this increase may result from the rise in housing costs. Further research demonstrates that lockdowns connected to the epidemic had a major impact on the labor markets of nearly all Nordic nations. Sweden was the lone outlier, choosing not to impose stringent lockdowns like its neighbors. Even Sweden, according to the report, didn't completely avoid labor concerns, as theirs were only postponed by 2 to 3 weeks. The same survey found that Nordic households reduced their expenditure due to the aforementioned workforce issues. This suggests that the housing market was primarily responsible for the rise in household net worth. What does this have to do with mortgages then? However, there are a few things you can do to streamline the loan application process. Number 5. Go large with your down payment. Nothing demonstrates to a lender your ability to save better than a sizable down payment. A sizable down payment lowers the loan-to-value ratio, improving your chances of obtaining the desired mortgage. By dividing the mortgage amount by the home's purchase price, the loan-to-value ratio is determined. Here is one instance. Let's say you want to spend $100,000 on a home. You apply for $80,000 mortgage with a $20,000, 20% down payment. Number 4. Lower your debt-to-income ratio. A debt-to-income ratio evaluates how much debt you have about your gross income. It is determined as a percentage by dividing your total recurring monthly debt by your gross monthly income. When determining how much property you can afford to buy and how well you can manage your monthly payments, lenders consider your debt-to-income ratio. A low debt-to-income ratio indicates that your income and debt are well balanced. The greatest debt-to-income ratio you may typically have and still qualify for a mortgage is 43%. Above that, most lenders will deny the loan because your monthly expenses are too high compared with your income. Number 3. Improve your credit score. A credit score is a single figure that lenders use to assess your credit risk and calculate the FICO score, which is derived from many pieces of credit information in your credit report, is the most widely used credit score. Payment background 35%. Payments due 30%. Credit history duration 15%. Credit mix 10%. New credit 10%. It pays to make every effort to attain the greatest credit score possible since, generally speaking, the better the mortgage rate you may receive, the higher your credit score you have. Check your credit report, to begin with, make any necessary corrections, and then focus on debt repayment, setting up payment reminders to ensure timely payment of bills, maintaining low credit card and revolving credit balances, and lowering the total amount of debt you owe. For example, stop using your credit cards. Number 2. Fix any mistakes. Don't assume everything in your credit report is correct after you obtain it. Look carefully to discover if any errors can harm your credit. Things to be wary of. Existing debts that have been paid, or discharged. Information that is wrong since it was not yours. For example, the creditor confused you with someone else because of similar names or addresses, or because of an incorrect social security number. Unauthorized information obtained through identity theft. Details from a past spouse that are no longer appropriate. Information that is out of date. False entries for accounts that have been closed. Checking your credit report at least 6 months before you want to look for a mortgage will give you time to detect and correct any errors. If you do discover a mistake on your credit report, get in touch with the credit bureau as soon as you can to dispute the error and get it fixed. Use one of the top credit monitoring services to keep an eye out for any strange behavior for added peace of mind. Number 1. Check your credit report. To assess if you are eligible for a loan and at what rate, lenders examine your credit report, which is a thorough account of your credit history. Equifax, Experian, and TransUnion, the big 3 credit rating organizations, are required by law to provide you with one free credit report each every year. You may monitor your credit report all year long if you stagger your requests so that you only request a credit report once every 4 months, instead of all at once. That's it from this video. Let us know what you think about the list in the comments section below. If you enjoy this video, please like video and also subscribe to our channel. Thank you.